This conference will now be recorded.
So, as you know, when we started this course in January, we said our goal was to be able to teach you how to prepare an income statement, statement of retained earnings, a balance sheet, and a statement. And we're moving into a statement of cash flows a little bit later in the course. But our goal is always to make sure that you can prepare those statements. And a lot of us are in good shape in terms of getting those statements prepared. So that was the mechanical thing that we do. And so now we want to get more into the theory of what we're doing at the start of class today. And so there are principles that govern the rules we use in accounting. These, first of all, come from the Securities and Exchange Commission, the SEC. After uh, a bunch of fraudulent activity in preparing financial statements, this body was created to oversee, generally accepted principles to be utilized so that the statements would be fair. So everybody can't decide how to prepare statements, would have issues. Most of the work on preparation is done by the FASB. These are the practitioners and educators who have the deeper knowledge and understanding, and they do most of the work in preparing accounting principles and financial accounting standards. So the SEC lets them do that because they've got more expertise. But it's the SEC's job, the Securities and Exchange Commission. We began to have trouble with uh, municipalities going bankrupt, cities and counties. And so a governmental accounting standards board was set up uh, for a similar reason. We got to have some generally accepted principles on how governmental accounting is looked so the statements are fair and reflect what they're supposed to reflect. Then we have the issue of everything is international now. So we have the IASB based out of London, which lays out the international standards so they will be uniform. Uh, and sometimes they agree with the U.S., sometimes they don't, but they're working together. But if you're going to be able to look at companies internationally, you got to have a uniform set of standards. If you don't have that uniform set of standards, then there's no way to judge companies internationally. And yet we invest internationally now. So we're working to have a uniform set of standards internationally. There are 15 generally accepted accounting principles that you are required to know. And of course, you will be tested on these in a multiple choice format on your next examination. The business as a single entity. The business is separate from you as individuals. And most of you should have completed the legal environment course now. And so you should know that there's a sole proprietorship. That's the small business that's operated by an individual. Then you have partnerships, uh, and that's where two or more people get together, but these are all unincorporated businesses. The problems with the proprietorship and the partnership is that there's unlimited liability. If something happens in that company, they can go against all your assets, all your personal assets. So most times now we're going to say a limited liability company. So you have to stay within the organization or a corporation. And then we have a special sub S corporation, which avoids double taxation, but it provides that corporate protection. So you always, you know, when you're operating a business, once you get a bit larger, you got to have protection because people will sue. Okay, you operating a beauty salon, child playing around, trips, falls, and hurt themselves, then you can be sued. If you don't have this protection, they can go against your personal asset. They can take your personal car and everything. So these are the types of entities. You see the discussion on them. You're expected to know that. Specific currency. In the US, we have everything in US dollars. And so if you have an international subsidiary, when you bring their financial statements merge them into yours, you got to convert their currency into the US currency so you can understand what's going on. You cannot add Russian rubles and whatever else to US dollars when those dollars when they're not comparable. And so there's that specific currency principle to work with that. Specific time period, not a difficult one. Most the time period typically is 12 months. So the statements have to say it. What's the time period? Is it 1 month? Is it a quarter? Or is it a year? Statements have to say that. Next, we have the historical cost principle. We're going to have everything in those statements at what we paid for them. So if we purchased something for 100,000 land and is now worth 2 million, we're going to leave that land in there at 100,000 until you sell it. If not, people will be writing up stuff all the time, saying their company is more valuable. So this historical cost principle is very important. Full disclosure, sometimes things happen after the statements are prepared, but before we send them out. So for 2021, financial statements are being prepared. But if something happens in 2022 that is going to affect your business, then even when you issue the 2021 statements, you got to say what's happening. Such as with Gulf, when they issued their statements, or BP, you had that spill in the flood in 1 year. The statements have to reflect that. And now, if your company is impacted by the Russian aggressive war, whatever it is, with Ukraine, suppose you're in the wheat business and bread business, and you were depending on wheat to come from Ukraine for your company. So that happened in 2022. But if you're doing 2021 statement, you got to highlight that. Okay, our grain comes from Ukraine. There, war, we may not be able to get grain, so our financial results may differ. Uh, and so that's the full disclosure. Things that happen after that year end have to be disclosed if we know that. Recognition principle. We're going to recognize income in the period when it's earned, not when the cash is received. Going concern, we typically assume that the business is going to stay in existence. Matching principle, and this covers a lot what we work with in adjusting interest. If we recognize the revenue and if there are related expenses, we want to recognize those related expenses also. So let's assume workers are paid monthly, first day of the next month. So in December, revenues of 400,000 are earned. That's the end of the year. The workers are paid in January. You would make an adjusting entry to record this expense because you recognizing the income in 2021. You want to recognize the expense in 2021 because there's a internal revenue service out there that collects taxes on your income. And so you don't want to pay tax on 400 when there's a $75,000 expenditure. You'd rather pay the tax on 325. And so, that's why we make these adjusting entries. Uh, if we recognize the revenue, then any related expenses, whether paid or not, have to be recognized in that year. Materiality, we only work with major items. So if something is very small, we don't have to be exactly accurate to the nearest dollar, $100, $1,000, depending on the company. Conservative accounting, we talked about that in terms of historical costs. You always want the statements to be conservative. Uh, when you're preparing statements, you always want them conservative. Sometimes there are practices in an industry where they do things a little different. So the oil and gas industry here in Houston, the energy industry, sometimes they're going to do things differently. They may be allowed to write up revenue because people got to buy the gasoline right away. And so sometimes they'll write it up, but issues can come up with that. Consistency. You got to use the same principle all the time. You can't do something one way one year and switch it back the next year. You can't do 6-month statements one year and 12-month statements the next, or 11-month statements one year and 13-month statements the next. You got to be consistent. Objectivity. Everything we need to do, we need objective evidence. It's got to be unbiased. And so, we've been making journal entries. We've been making journal entries. But there always has to be objective evidence, a sales slip, a bill, a check that's written before you make a journal entry. So you just don't go around making journal entries. You have to have objective evidence. Accrual basis, we talked about this before in some of the recognition. We're going to recognize revenue when it's received. We're going to recognize revenue and we're going to accrue the related expenses. So that's called accrual basis accounting. And that's generally accepted accounting principles. And as I indicated before, I put this handout in course content so you'd have it. You can follow along here. It's in the primer, but just so I could get to it a little bit better because I'm covering several areas, I put it together, you know, what we'd be dealing with. So we just have it all compact together. And you could follow along, much easier. Assessment of cash flows. We'll get to this when we get to cash. Even though we're using accrual basis accounting, we still have to assess whether you got cash to pay your bills. So the fact that you got money coming in doesn't matter. When payday comes, you got to pay your employees. When the first of the month comes, you got to pay your rent. So we also have to go and assess cash flow. And can we pay our bills? Are there any questions on these 15 concepts that you're supposed to know and you're going to be tested on your next exam? Are there any questions? Learn them in the primer. There are some objective practice questions. Look at those. Okay. Accounting cycle. This is what we're working through. When we started this course, we analyzed transactions and we made journal entries. Then we posted to the ledger and we prepared the trial balance. We skipped steps 5 and 6 and we went on to 7 and 8, prepare the financial statements and make the closing entries. Now we're going to come back to 5 and 6, which is making adjusting entries. Now, anytime you make a journal entry, you have a debit and a credit. You got to have a debit and a credit, and you got to post it to the ledger. And so we can either prepare a trial balance here, or we can make these entries and post them and then prepare an adjusted trial balance. So you can prepare it once or twice. You can prepare it after the regular entries, make adjustments, prepare it again. Most times, we'll just prepare it the one time. That is, we'll make our regular journal entries, then we'll make our adjusting journal entries, and then we will go through with an adjusted trial balance, prepare these statements, and close the account. So 7 and 8 doesn't change. We're just going to add some more journal entries in here. So why didn't we add these journal entries before? Why didn't we add them before? Well, sometimes adjusting journal entries cause problems. So I just kind of take them out, get through the whole process pretty much. Now we're going to come back to these adjusting entries. And the reason adjusting entries cause problems is in these regular journal entries, I'm telling you what the dollar amount is. But when we come to adjusting entries, you got to calculate the dollar amount. And just that little adjustment has a tendency to make adjusting entries difficult. Does everybody see there's so this could be here, and does everybody see who's assigned for next time to make those journal entries? Your 10 points, does everybody see that? Good. So we know we have to pay attention, and you got to make all the journal entries, and if somebody isn't here next time, then you can go and do the journal entry and get that 10 points, and you will have your 10 points. Let's talk about adjusting entries. These are journal entries that are made on the last day of the accounting period to ensure that we have accrual, we're following accrual method of accounting, and we're matching, what we just talked about in that theory. That way our income statements are going to be more accurate, revenues and expenses, and our balance sheet is going to be more accurate. If we don't make the adjusting entries, then our accounts are off. And so we will, talk about these, but this is just a little highlight for your summary of adjusting entries. They're prepared typically on the last day of the period. You got to calculate the amount. We make the journal entry with a debit and a credit, and we post it to the ledger. Let's look at a journal entry. And you remember when we were on page, 37 and 38 in the primer, and we were making journal entries. And when we first started making journal entries, we looked at a case where you could buy some supplies, paying cash, and buy some supplies on account. So if we look at those two entries on page 37 and 38, the first one, I think if we look at that entry, I think we paid cash for $3,000. So let's just assume, well, let me make it $2,000 just in case. So assume that we, first of all, bought cash for $2,000 in supplies. And then let's assume that we bought $7,000 in supplies on account. Supplies are pencils, paper, general, small purchases like that, things that we need in the business. All business buy these supplies, tape, ink, whole lot of things they buy. And so in this case, let's assume we bought 2,000 and 7,000. So if we look in the T account, we had $2,000 in supplies when we posted, and we have 6,000 in supplies. So right now, excuse me, 7,000. So right now, the supplies account has 9,000 in it. It has 9,000. We go and we take a inventory of the supplies. Only 3,000 there. So we bought 9,000 worth. We take an inventory. We only have 3,000. So if we don't make it an entry, we would be showing the supplies at 9 and no supplies expense when we've used the supplies. And so we've got to make an adjusting entry. The problem says we only got $3,000 in supplies. So even though 9,000 is in the account, we only got $3,000 in supplies. Okay? So we only got $3,000 in supplies. So we need to make an adjusting entry because we have utilized supplies. And in making that adjusting entry, make an entry so that the supplies, the amount of supplies goes to 3,000. So what is that adjusting entry going to be? For these people got 1, 2, 3, 4, 5, and 6.
Will we credit supplies for 6,000 and
Yeah.
debit supplies expense for 6,000?
So how'd you get 6,000?
Because right now we're at 9,000 with the supplies, but you wanted to end up supplies having a debit of 3,000, and to get from 9,000 to 3,000 is 6,000.
So we've got to make this entry, debiting supplies for 6,000, for debiting supplies expense and crediting supplies 6,000. So when we make this posting and make the AJE for 6,000, now we're gonna have 6,000 in the supplies expense. If we don't make this entry, what? The assets are overstated and the expenses are understated, so the revenue is overstated. So when we first buy the supplies, they are an asset. But once the supplies are used up, once they're used up, then they're no longer an asset. And you got to move it to the expense. So when you first buy the supplies, they're an asset. It's kind of like you going to the store and buying 9 steaks. Okay. Expensive steaks, $1,000 a piece. You buy 2,000 in cash, you buy 7,000. You got 9,000 in steaks at the beginning of the month. You go out of town, you got a roommate or two, and you come back, it's only $3,000 worth of stakes in there, only 3 stakes in there. So what's happened to the other stakes? You had 9,000 stakes in there, 9 stakes at 1,000 each when you went before you went out of town. But you came back and you got a couple of roommates and you only got 3,000 in there, 3 stakes left at 1,000. So what has happened?
The roommates ate the steak.
They ate the stakes. So as long as the steaks were in the freezer, they were an asset. But once they're eaten, they're no longer an asset. They're an expense. So this is the entry, the entry that we have to make. So how's the problem written up? The problem is written up. You made a purchase of this, you made a purchase of this, and then the problem says you take an inventory and there's only 3,000 left. Therefore, with that information, you got to calculate the expense. So I'm not going to tell you what the expense is. You got to calculate it. Any questions? Now, let's see. There are 4 types of adjusting entries. So sometimes that also causes problems. We have prepaid expenses like those supplies. We have unearned revenues. We have accrued revenues and we have accrued expenses. So we got 4 types of adjusting interest. So as we normally do, we aren't going to try to do all 4 at once. We're going to do the easiest one first, the unearned revenue. Then we're going to come back to the prepaid expenses. So you don't have to worry about those. We're just working with the deferrals, prepaid expenses and unearned revenues. That's all we're talking about today. And that's all we'll probably talk about on Thursday. When we have a deferral, cash has already been paid or received. So when we get ready to make that journal entry for the deferral, we've already had what's called a preceding entry where we paid cash, or we got unearned revenue where we got the cash in advance. Now let's go up here and look at a couple of other things about adjusting entries. Maybe it's down this way. Let me just see. Yeah, let's look at our important rules for adjusting entries. When adjusting entries are made, first of all, cash is never in the adjusting entry. Cash may be in an entry before the adjusting entry, or it may be in an entry after the adjusting entries. But cash is never in the adjusting entry. And I'm going to say it a second time. Cash is never a part of the adjusting entry. And I'm going to say it a third time. Cash is not part of the adjusting entry. We may have had some cash entries related to these items, but when we get ready to make the adjusting entry, cash, I don't want to see cash in your adjusting entries. Secondly, an adjusting entry is always going to involve at least one income statement account, a revenue and expense, and one balance sheet account, an asset or liability. So it's always 2 accounts. One is going to be from that right side of the chart of accounts, revenues and expenses, and one's going to be from the left side, assets and liabilities. So those are two key rules as you make adjusting entries. So it really is not that hard. You just got to make some calculations. So what I'm going to do, since the people with 22 through 26 are going to be up first, we're going to go to unearned revenue. Unearned revenue. Now, ACE students have to know all four types, but other students just have to be able to do unearned revenue and prepaid expenses. I don't want to overtax them, but these ACE students, you got to be able to do it all. So the first type of adjusting entry is unearned revenue. This occurs when your company gets the cash prior to the performance of the service. And so the company is happy. Sometimes people have to have those Jordans ahead of time. So they will pay the shoe store in advance to ensure that they're going to get their Jordan. Or there's a special game coming out. And so they're going to pay GameStop in advance. So GameStop just loves that because they got the cash. So, and they make a preceding entry to debit cash and credit unearned revenue. So let's assume GameStop gets $50 in advance from 200 customers. What type of transaction is that? Again, $200 in advance. With $50 in advance from 200 customers. What's our journal entry type? Cash coming in. Got to be 1 through 6. Remember, A students, you're responsible for all the journal entries now. So that will be a type 4, where we're going to debit cash and credit unearned revenue. So GameStop, when you come in there and you give them the money, they're also happy. So they're going to debit cash for how much? Is that $10,000?
10,000.
Now, most people in here probably has paid somebody in advance for something. Most people probably have done that. So we're going to debit cash and credit unearned revenue. Now, 2 months later, the games are arrived and are picked up by the customers. What kind of account is unearned revenue? What kind of an account is unearned revenue?
Is it temporary?
No, not temporary. Look on your chart of accounts.
It's a liability.
Unearned revenue is a liability because for GameStop, if they don't deliver those gains, they got to get people their money back, or somebody can ask for their money back. So up until that point, the unearned revenue is a liability. So we debiting cash and we crediting unearned revenue. It's not earned yet. It can't go on the income statement yet. It's a liability. Now, 2 months later, when the gains are picked up, then we have, I think this is still a type 20, where we're going to debit the unearned revenue. So it's no longer unearned now. We're going to credit sales. So sales can't go on the income statement until the gains are delivered. So this is the first type of adjusting journal entry. Unearned income. It's the easiest type. I expect everybody to be able to do this on a quiz on next period. So if you can't, tell me now. Get everybody in here and make this entry. Now we'll work those problems.
Could you explain it once more? I'm just a little bit lost.
It's a little bit lost. Okay. Suppose you are running a store where you sell exclusive purse. What's an exclusive purse? It's hard to get. What's an exclusive purse? Are there any exclusive? Give me a name.
Birkin bags, I think are like 80,000.
What's that?
Birkin bags.
Okay, so Birkin Max is 80,000. Okay. Now, if you're running a company and you selling something for $80,000, if someone said they want it, what are you gonna probably ask them to do?
Give a deposit.
You're gonna ask them for the money in advance. So let's assume we just change our example. So you say, pay me in advance and I can get it for you, but you gotta pay me in advance. You see that you don't want to go buy a purse, and it may cost you $40,000, but you got to pay the 40,000, so you aren't gonna go out there and buy something. You aren't gonna go out there and buy something unless you know you can sell it. And so that's kind of how. So we see that you're getting ready to sell something for $80,000, you got to buy it. So you're going to make the people pay in advance. And that's what I do. Now, when the people, when the, but if you don't get that purse, you got to give people their money back. So at this point, you debit cash and credit the unearned revenue because you hadn't earned it yet. You got the money, but you hadn't earned it. Then, when the purse comes in and you give the purse to the person, now you've earned the money. So you don't have a liability to that person anymore. They got the purse. You can now recognize your revenue of $80,000.
That makes so much more sense. Thank you so much.
You're welcome. So yeah, okay. So that's a major part of doing business, yeah. So since I gave that brilliant example, everybody's gonna get it right on the quiz next time, right? That brilliant example. Okay. So just think about it. So, uh, seriously, I'm not gonna tell you the dollar amounts, but you can kind of figure these out pretty easy. So that's the difference in the entry. So next time, people 22, 23, whatever, 24 are going to work some journal entries involving this. So those the 22 through 26 people who have those journal entries. That's the first thing we're going to do next time. Okay? So that's 10 points on your grade next time for those people who are assigned. Got it?
What are the numbers? What are the, because I see some that are like 1 through 6. What are we doing with that?
We're getting ready to talk about it.
Okay.
That's the second type of journal entry. So I want to do the easiest one, which you should better relate to, as we have, we'll review it. But that's the first thing that we do. So notice what happened. We had a preceding entry where we got some cash. Then we delivered the goods. Then we could recognize the revenue, but it was a liability prior to that. All right, let's move to the 1 through 6 people for next time. Prepaid expenses. Anytime you buy an asset for your business, it's virtually a prepaid expense. You don't buy the asset unless it's going to generate revenue, because that asset is eventually going to end up on the, being written off, and it's going to be on the income statement. So you don't buy supplies, you don't pay for insurance, you don't buy inventory, you don't even buy long-term assets like equipment and autos, because they're going to be written off to the income statement. So most assets are prepaid expenses. We debit the asset account when they're acquired. So that asset is debited, and we either credit cash or we credit accounts payable, then we pay the account payable and we credit cash at that point. So there's a preceding entry. But either it's through the passage of time, such as with insurance, or through usage, such as supplies, that item is used up, so it is no longer an asset. So we have to make an adjusting entry. So whether it's supplies, whether it's prepaid insurance, whether it's autos, whether it's buildings, whether it's equipment, they're going to eventually end up on the income statement. So let's talk about supplies. Suppose in the simplest example, supplies, paper, pens, etc., we buy them. And assume that 5,000 is purchased at the beginning of the period. So to run a business, you're going to buy your coffee cups and your coffee, your ink, your glue, your envelopes, your stationery. You're going to buy all of that stuff together, and you're going to debit supplies and credit cash. Now, what you could do is every time you use something, you could debit supplies expense and credit supplies. Every time a coffee cup was used, you could debit supplies expense and credit supplies. But nobody's going to go around and do that. What they're going to do is, okay, at the end of the period, they're going to take an inventory, a one-time inventory of how much of the supplies of the 5,000 is left. And so if it's 5,000 and it says 2,000 is left. So we got 5,000 in the supplies account now. We got 5,000. And we told 2,000 is left. So what do we got to do? We got to make this adjusting entry to do what? Say how much was used. So if we bought 5,000, if you have $5,000 in
3,000,
the bank at the start of the period and 2,000 at the end, how much did you spend?
3,000.
3,000. So that's how we get that entry. Any questions on that? Any questions? All right, so now we're dealing with these, got to get these A students involved, and we don't want them doing anything just this easy. Okay, so we gotta make them work a little harder. So, Ms. Miller, let's assume
Yes.
that this is 2018, 20, the 2021. So we make this entry at the end of 2021. Okay. So let me see if I can add some rows in here. Insert rows below. So now we're going to come to 2022. And in 2022, we're expanding. So we're in 2022 now. We need using more supplies. So let's assume that we bought $8,000 worth of supplies in 2022. So in 2022, we're going to debit supplies. We're going to credit cash for $8,000. And lo and behold, let's see if I can add some lines below here. Insert row below. All right. So now we're getting in here into 2022. So notice that we began, let me put this 3,000 in here. Go ahead and get those posted, and we would have made this entry, and we would have closed it out with a closing entry. So you all know all about those closing entries. So we would have closed this out in 2021. Now we're in 2022, and we buy supplies of $8,000. But at the end of 2022, there's only $4,000 of supplies left. What's our AJE going to be? So we got to make this entry now in 2022. What's the amount going to be?
4,000.
Okay. How much? Suppose this is your bank account, and you have 5,000 in the bank in 2021. You spent 3. You had 2,000. You put 8,000 more in there.
It would be
This is
10, right?
2021. You put 8,000 more in there,
Oh, it'll be $6,000.
but you only got 4,000. How much?
6,000.
How we get 6,000?
Because the 10 minus 4 is 6.
So you would have had 10,000 in there this time. And so our AJE the next year is 6,000. So I expect my A students to be able to work with beginning balances in the supplies account and give the adjusting entry. So just like with your bank account, you don't just stop it. You keep carrying it forward year after year. So the supplies account is doing that. Are there any questions? So that's all I want you to know for next time. And that's all I'm going to quiz you on next time. I'm just going to quiz you on unearned income, and I'm going to quiz you on supplies. we're going to review those homework problems on unearned income, and we're going to review the homework problems on supplies. And what I expect is that you're going to be able to make those adjusting entries. Are there any questions?
Yes, Professor, I'm sorry I missed it. Are the for the homework assignment, are the questions coming from the JHJ rental?
No, these are actually in this handout here. I think I
Okay,
just put it all in here together. I just made it
okay.
easy for you all. I
I have a question.
think these are the. Wait a minute, let me get out here all the way down here. Okay. Yes, I think they start at the end of the handout. Adjusting journal entry study problem 3-1. Yes, what is the question?
So, you assigned us a certain number, but they're not all on the Excel spreadsheet. Or
I
are we
just,
supposed to do all of them?
you got to do all of them. I assigned you the first few. How many journal entries are there? How many total journal entries are there?
I'm not sure. I'm not looking at the handout. I'm looking right here.
So it should be about 40 something, but I didn't want to overwhelm you. But everybody has a 10 point, will have a 10-point homework AJE to do. That way everybody will learn how to do at least one. Just like,
So,
just like you
what
learn
we're
how to
doing,
do
we
regular
just put it on
journal
somewhere.
entries, you're gonna learn how to do AJEs. I just assigned the first few. So you should have all of those work. You're supposed to have all of them work. I'm just calling on some people to work them. And
Mm.
everybody will be called on eventually, so they'll have time for their 10 points. Okay? Now at the end, there's a little summary of adjusting entries. That's at the end of the handout. We talked about the easiest one, unearned revenue. The liabilities are overstated and the revenues are understated until the journal entry is made. We debit the liabilities and we credit the revenue. So this is the AJE, and there was a preceding entry where we had cash, but that AJE does not have cash in it. Then we looked at the first of prepaid expenses, which were supplies. And the assets are overstated because we used the supplies. There was a preceding entry where we bought supplies. Then we're going to make an adjusting entry. And it's going to be a debit to an expense and a credit to however it works best for you. There's also a chart of accounts that I prepared. Oh goodness, I hope it's been recorded earlier, but we'll see. Uh, in this chart of accounts, which is different from the others, in this one, which is different from the others, I've got the AJEs by the accounts that they're going to relate to. So if it's AJE Roman numeral 2, then you'll see that the unearned income is AJE2 debited, and the sales is AJE2 credited. So it's kind of listing what those accounts you got, because you do have to come up with the accounts, but that helps you. Then for AJE1, when we begin to deal with those assets, I got an AJE1 by the accounts involved. So by all of these assets, supplies, prepaid insurance, auto, these are all AJE1s. And we just working with supplies now. We working with the others later. But we debit AJE1, but we credit actually the supplies. Then we'd be debiting the expenses. Here's an AJE1 insurance, interest, supplies. So if you look at this chart of accounts, what you will see is, I've just sort of put in what accounts relate to what adjusting interest to help it out somewhat. So you kind of work with that. And then this is this problem that starts with 1 and goes all the way to 40 something. So everybody will eventually have a journal in AJE, and eventually you're going to turn them in all to me. Are there any questions? So you got to look at this and think about it. Let me see.
Professor,
Yes,
um, I have 23 and I only see a chart here. I'm not sure if I'm looking at the right thing.
you have which
A
one?
chart 23 and I just see a chart here to actually work the problem. But there's like there's no problem by 23.
Let me see. Let me see. You got 23, and
I think it's page.
I didn't put page numbers on this handout. I should have done that. Okay, so here's the problem. Let's see. 10, 15, 21, 22, 23. Oh, let's see, 22. It may have gotten cut out. So what I'll do is I will put something in for some of the, thanks for picking that up. I'll put a new one in. So I'll update this. I'll have page numbers and I'll put the 23 one in there that got cut off. Okay?
Okay, thank you.
You're welcome and thank you. Oh, let me see if I can stop sharing.
Dr. Boyd, where is the recording located?
The recordings are typically on YouTube.
Okay.
So I have a YouTube channel. You just go to Joseph Boyd Accounting or whatever. I would show it to you, but I hate to even deal with it going. Yeah, all the time they're updating this thing. Okay, let's talk about face to face, going back face to face. So, uh, what's you all's feeling about that?
I think everyone's pretty comfortable with doing online now, so I'm not sure how everyone feel going back face to face.
I would rather online.
Callahan?
No comment. It's gonna be what it's gonna be, and I'm just gonna do what the group does because I think that a lot of people want to be online for whatever reason.
What sort of happens with online, and unfortunately this class and I have another class after this, people have a tendency not to come. So I hate that we got sidetracked. Now, there is the possibility, but not a possibility. I'm willing to do face-to-face office hours. So if you need face-to-face, we could do a Wednesday or something like that. So I don't want to not have people have that ability if they want to do face-to-face. And it just depends, I'll see how all the classes go. And I'll be doing some checking tomorrow because I can't go in the classroom and do this. I mean, they've got blocks that keep you from putting on this program, so that doesn't work. The last time I was there, I was able to teach out of my office. And so that way I can be on campus, do some office hours and things like that. So we'll look at it, but I don't want anybody to be shortchanged in terms of how the instruction is going to work best. So if there's a need for face-to-face office hours, then I would do that. Or as I said before, if we were going to go this way with the class, then I'd have face-to-face office. If the class is face-to-face, then I have some virtual office hours and virtual times too. But just look at it and see. Keep me posted uh, in terms of what's happening. If you work, the way I have the course laid out, a lot of time the face-to-face is needed because things are not laid out. But for the rest of the semester, I'm going to give you a handout like what we have now. So I'm going to pull out what I'm going to present and try to have everything there in a concise way so you can go to it. In terms of the recordings, there are recordings from prior semesters and everything. I hope this one is there, but if not, I'll work through that. So there are some issues and problems. And I'll just let you know personally, I prefer to teach face to face. Because, it's just, you never can tell what's going to happen with the technology. And I had to get up this morning and thunder and lightning, I had some exams. I had to put them on in case I lost it. So, but realize that, if there's ever an issue one way or the other, let me know in terms of face to face. If there's something I need to do, then let me know because I'm committed to everybody learning in the best way possible. Now, the way I'm doing it, you're going to learn. And I mean, the performances are there in general. So I'll try to get those quizzes graded, and I'm looking at your study problems and things like that. So let me look and work through that. But I got through the first few, and they're looking okay. Now, the first two I saw look too good. So make sure you're doing your own work. You're going to get most of the credit, even on the exam, but I need to see your own work, because that reflects, especially on homework, to, what the exams are going to look like. So if I think you know it, I'm going to challenge you more. So just keep that in mind. So hopefully this is recorded. If not, just find an early recording that deals with adjusting entries. But I do teach it kind of differently. And so what we did today, I'm going to go back over it again, but you all are going to work the problem. And then we'll have a short little practice quiz. Won't be, or it may be a problem attendance quiz, so it won't hurt you, but it'll be extra points. You just got to get over the fact that I'm not telling you what the numbers are, and you got to make that. That's what you got to get over. So once you can get over that, it's not that bad. So you learn how to make regular journal entries. You learn how to do financial statements. You learn how to do closing entries. Now you're going to learn how to do adjusting entries, but you can see why I pull them to the side. Let me get you through the overall process, then we'll come back. Okay, well, you all have a good one. Let you out a couple of minutes early, and we'll see you on Thursday.
Have a good day, Professor.
Professor, can I ask a question
Y'all,
really fast? Professor Boyd.
uh, yes,
Do you know when we will see our midterm grade for this class?
by the end of the week.
Oh,
By the end of the week.